Welcome to TFN's Smart Trading Action Alert. I'm Laura Cadden. For the last 8 months, bad news about increasing default rates in the U.S. subprime mortgages have been dominating the media. This high-risk, low-income segment accounts for about 10% of the U.S. mortgage market. While only 1.4% of all mortgage holders face default, more than 1 in 7 U.S. home buyers with subprime loans failed to keep up with mortgage payments in the second quarter. And the numbers are likely to increase as mortgage rates reset. Stock markets around the world have corrected sharply since posting record highs in July, at least partly in reaction to the ongoing crisis in the subprime sector. Lenders have tightened credit, and central banks around the world have pumped over $400 billion into fresh liquidity to the system to head off a credit crunch. My guest expert today is Ian Cooper, editor of Death Cross Trader. He first brought the subprime mess to the attention of TFN viewers back in February. So Ian, the Federal Reserve has reported that overnight lending to banks has decreased significantly in recent months. This would seem to indicate that there is no longer the great need for emergency funds to ensure liquidity to the lenders. What is your take on that?
Well, global banks have pumped over $400 billion into the market, as you've said, but it's been falling because people expect to see a rate cut come September 18th. They expect either a quarter point, which is already priced in the market, and they also expect to see a half point, which may not be fully priced in the market. But by cutting rates, which is not a good move on the Fed's part, you're also increasing inflationary risks. You're killing the dollar. You're sending gold to 1,000. You're sending oil to 100. You're going to create such a mess simply to save housing and the lenders that it's not worth it. If we see a Fed cut, we're going to be in an inflationary mess.
We talked about subprime for a minute. I know that you closed out 2 of your subprime put plays in one of your trading information services. Have the financial markets started to price in the mortgage default risk? No,
absolutely not. You have to consider that the peak months for mortgage resets on adjustable rate mortgages starts in October. In October 07, $50 billion of ARMs are going to begin resetting. After October, it's going to be $30 billion a month for over the next year, which could come out to maybe $1 trillion in resets. You're going to have a lot of delinquencies and a lot of problems down the road, and there's no way really to head that off.
Well, let me ask you about this. The Shanghai and Hong Kong markets are very dependent on U.S. consumer spending. How can we interpret their big increase in their markets as opposed to the U.S. versus the European markets?
It's actually a shock. All I can say is they have very strong fundamentals, very strong earnings potential. They have great growth. People want to invest outside of the United States, but they also have their inflationary risks. They have their own real estate bubble they're dealing with, and like I just said, they have their inflationary risks, and they're dealing with the potential of a U.S. recession, which can wreak havoc on that market. But as I said, it's very strong fundamentals and very strong earnings growth is sending a lot of growth their way. However, we are seeing signs of cracking as we get into fears of a possible U.S. recession.
Now, in your opinion, what are the next big dates, milestones for the subprime crisis that you perceive coming?
Well, like I said, October 2007 begins the resets again. $50 billion will reset in October. After that, $30 billion a month. You also want to keep a look at auto sales, which is suffering as
always a sign of a recession.
Right.
Absolutely.
You want to take a look at consumer spending issues coming out this Friday. You also want to keep a look at housing delinquencies. You want to keep a look at housing prices, which are still 15% to 17% overvalued. And you also want to keep a close watch on credit card delinquency, which is rising significantly because what's happening is people used to tap into their own home equity in order to pay off their credit card debt. Now they can't do that anymore. So these credit card companies are seeing substantial debt. Credit card companies right now are seeing debt of $850 billion across the United States. Imagine if one company were to default or have to write off 10% of that. That's a real issue.
So is this where you see opportunities for traders then?
Absolutely, absolutely. There are 2 companies I'm looking at for traders. There's Capital One Financial as a result of the credit crunch with credit card delinquency. Now, when a homeowner defaults on a home, the lender can foreclose on that property. But when a credit card company sees a default rate, they can do many things, one of which includes extending even more credit to that bad lender.
Right.
Or becoming even more aggressive in their marketing campaign to market credit to those that don't really have the backing to pay it back. And one of those is, we believe, is Capital One, which has fallen from about 80 to less than 65 in the last few months. Now, Capital One may have spun off its Greenpoint mortgage, division, but it's still holding $12.5 billion of mortgage debt. It's a subprime credit card company, and it's also watching as its auto lending sales dwindle as well. So we believe that Capital One will fall even further. The other company that we like is Countrywide Financial, which is a favorite. We shorted that at $30 and called for it to break through 18. It's now on its way to 16. What's interesting to note about Countrywide is that you have a CEO that's making billions of dollars on a company that's successfully being run into the ground. Months ago, the company said, we have no severe issues with mortgage, we're not having any problems, we're not seeing any evidence of problems. Then reportedly, the CEO was selling shares. Then it came out that said we have severe disturbances with our mortgage delinquencies, and at the same time they were also saying, listen, we have $50 billion in liquidity to weather this storm when things hit the fan. They then borrowed, I believe, more than $14 billion to help weather the storm even more. Bank of America then lent them $2 billion to help them weather the storm even more. That's now gone. Now they're in their second dealing. They're asking banks to help them again. They need another deal of $2 billion to help them get through this current liquidity crisis. So, we believe that Countrywide Financial is as much as people love the company, we believe that it's going to the high single digits.
Very interesting.
Yeah.
Now, you've written up a report that I can put up on Taipan Financial News. Is it related to both of these?
Absolutely. It's related to Capital One, and I also talk about Countrywide Financial at Death Cross Trader.
That's great. We really appreciate it. Thank you so much for the
thank you.
information. We'll post Ian's report on TaipanFinancialNews.com under the Investment Strategies section of the homepage. To learn more about Ian's trading information service, go to www.deathcrosstrader.com. Please join us next week for another opportunity for profits on TFN's Smart Trading Action Alert. For Ian Cooper and Taipan Financial News, I'm Laura Catton.